Hi everyone, very good morning and welcome back to Crack Grade B. So, just wait for a second. Yes. So now we are good to start. Yesterday we have covered two types of ratios, right? We are right now doing accounting ratios for the EPFO examination, and yesterday we covered activity ratio, correct? As well as some of your liquidity ratios. Now after that, what we are going to do is, today we have two kinds of ratio with us and we'll be doing that. Sorry, I missed up the point. So yesterday we did liquidity ratios and solvency ratios. Today we will be doing activity ratios and profitability ratios. Correct? So in your solvency ratios, one more ratio I thought of including, because this is also quite some time the question is being built up onto this, right? So what is the question? Interest coverage ratio. It is a ratio which deals with the servicing of interest on loan. See, this particular ratio seeks to know whether you will be able to pay out your interest or not. Fine. So whatever amount of loan you have taken, whether you will be able to service interest of that or not, whether you have sufficient profit for it or not. So this kind of ratio, whenever you go and seek a financial kind of loan, they also your banks also check this kind of ratio, right? Interest coverage ratio. What do they see over here? So they see what are your net profits before interest and taxes and divided by interest on long term debts. So net profit before interest and taxes divided by, just wait for a second. Yeah. So net profit before interest and taxes divided by the tax on long-term debts. It is also known as EBIT, right? So in short, this thing is known as EBIT divided by your interest on long-term debt. What is the amount you are earning before paying out your interest as well as the taxes? So these are the things that are washed out for. Now apart from this particular thing, there is one more ratio. I'll just briefly tell that particular ratio to you. So keep that into your mind. See, first, let's read interest coverage ratio. So it is a ratio which deals with servicing of interest on loan. It is a measure of security of interest payable on long-term debts. It expresses the relationship between profits available for payment of interest and the amount of interest payable. Now, there is a similar ratio which is similar in intent like interest coverage ratio. Fine. So you guys have to tell me that ratio's name if you know about it. I don't know whether you know about it or not. So without leaving it on to you, this is debt service coverage ratio. So this is an added solvency ratio for you guys and you have to search for it, right? I have told you interest coverage ratio. It is similar in intent and purpose just like your interest coverage ratio. You have to tell me about the debt service coverage ratio. Okay, I will mention about this in the comment section after this particular video. But till the time you guys are watching this particular video, I would like that you please go and read about this particular ratio on your own. Debt service coverage ratio. Fine. Now next we have completed the solvency ratios. All such ratios which depict your solvency, right? Whether you will be able to pay off your debts or not. What is your financial position, like that? If you are able to tell that, that all is covered under solvency ratios. Now the next ratio that we are going to cover is the activity or turnover ratio. Activity or turnover ratio, these are yesterday also when we discussed the introductory chapter of ratios. At that point also I told you that these are also called as efficiency ratio. Never ever forget the other names of the ratio, because most of the times those names can be asked, because they are confusing, they are lesser known, that's why. Fine. So efficiency ratio is the other name for the activity or turnover ratio. So number one out of this is your inventory turnover. ये मैंने आपको कल भी समझाया था. Fine. So the word turnover actually depicts sales, right? Why it is used different in this particular formulas, etc., we'll come to that later on. But normally in normal parlance what we say is the word turnover depicts the sales. Okay, it depicts sales. Now let's see what is the formula of inventory turnover ratio. See, inventory turnover ratio is equals to cost of revenue from operations divided by the average inventory. Cost of revenue from operations. Cost of revenue means also known as cost of goods sold. Revenue means what? Revenue means sales, right? So whatever sales you have done, what is the cost for that? So cost of goods sold divided by your average inventory. How it is calculated? COGS divided by average inventory. Average inventory means opening plus closing inventory divided by 2. So this is how it is calculated. Now why the calculation is being done like that? See, what happens is whatever sales you are doing, correct, that is directly related to the inventory. By calculating inventory turnover ratio, we do not want to keep the inventory for a longer period of time. I repeat, we do not want to keep the inventory for a longer period of time. So you see, the inventory turnover ratio, it determines the number of times inventory is converted into revenue from operations during the current period. Fine. It studies the frequency of conversion of inventory of finished goods into revenue from operations. It is also a measure of liquidity. It determines how many times inventory is purchased or replaced during the current year. Now, I always tell you, yesterday's lecture also I told you that whenever you are reading ratios, please also understand that whatever ratio you are reading, its high ratio will be good or a low ratio will be good. Fine. Low turnover, what it is going to suggest you, it is a danger signal. It is not a good signal. Having low turnover means your inventory is lying as it is. You are not able to do good amount of sales. Your inventory is rotting into your go downs. Fine. So we want our inventory to quickly move, and that is why a high turnover ratio is good, but it also be carefully interpreted. It may be due to buying in small lots in selling quickly at low margins to realize cash. See, there are both the points over there. Although we need a higher inventory turnover ratio, but still it should be looked upon that why this high inventory turnover ratio is there. See, I'll tell you two situations, not very important, but will tell you. Suppose I have bought this much lot of inventory, right? Just for the imagination purpose, I have bought this much lot of inventory. Now, this inventory is quickly selling. It is quickly selling, right? So this is a good sign for me, obviously. But in comparison to that, suppose I just bought this much inventory, I just bought this much stock, and if I say that yes, it is quickly selling, my inventory is quickly going out of stock, that would be a misjudgment, right? We are not judging the situation correctly. If you have lot of inventories, that is selling quickly, a good sign, right? But you just have purchased a small quantity, obviously that is going to sold out fast. So this is the interpretation of inventory turnover ratio. I hope you have understood, right? While calculating inventory turnover ratio, do we use revenue? No, we do not use revenue. We use the cost of goods sold, right? So why we use cost of goods sold? Because inventory, we do not want a amount of profit over here. Inventory is there because inventory is valued at whatever the cost of production is, right? So we want to compare it with the cost of goods sold, not with the revenue. Now next thing, average inventory is calculated opening stock of inventory plus closing stock of inventory divided by 2. Okay? Now it also depends, see, in a business there can be different kinds of inventory. We have inventory of raw material, right? We also have inventory of finished goods. So the inventory turnover ratio can be calculated separately for both of them, right? So I can calculate a inventory turnover ratio separately for my raw material, and in similar situation I can calculate inventory turnover ratio for my finished goods also separately. And in that particular case, average inventory will be raw materials average inventory. Opening stock of raw material plus closing stock of raw material divided by 2. And in case of finished goods, it will be average inventory but opening stock of finished goods plus closing stock of finished goods divided by 2. That is called your average inventory. Fine. Now next thing, see. Next is we have trade receivables turnover. So we would also like to know that whether you are able to collect your debtors on time or not. See, this is very important. If I have sold someone goods worth rupees 1 lakh, so I would like to receive my money as soon as possible, right? I want funds to carry out my business or to carry out my activities. And if my funds will remain blocked in the hands of other persons, how I am going to perform my business? Understanding my point? So this is why we are calculating the trade receivables turnover ratio. See, it expresses the relationship between the credit revenue. Obviously, for calculating trade receivables turnover ratio, we have to use credit sales because cash sales has got no relation with the debtors. What did I say? For your trade receivables turnover ratio, what you have to do is you have to take into account the credit sales, because ultimately this is what matters. Debtors have arisen because of the credit sales. Fine. So this is how it is calculated. Trade receivables turnover ratio, net credit revenue from operations divided by average trade receivables. Now how we calculate average trade receivables? So it is calculated as opening debtors plus if you have any opening bill receivable, fine, plus closing debtors plus closing bills receivable, and all of this will get divided by 2. because we want to calculate the opening and closing average. Fine. So this is your trade receivables turnover ratio. The liquidity position of the firm, it depends upon the speed with which trade receivables are realized. If you are able to faster realize your trade receivables, it is a good sign, right? So this ratio indicates the number of times receivables are turned over and they are converted in cash in an accounting period. Higher turnover means speedy collection from trade receivables, and it is obviously a very good sign. It means that even if you are doing the credit sales, you are able to collect your money on time. Fine. So this is what a higher ratio indicates. Now next is, sometimes they can also talk about the average collection period, right? So this ratio also helps in the working out the average collection period. If someone wants to know, like I want to know, someone has told me that yes, they are having a debtors turnover ratio of 10. I said, okay. So I would like to ask that in how many days on an average you are able to collect your debtors, right? So the person will say it is super easy. What you have to do, if you have to find out average collection period, so there are 365 days in a year. I said, yes, there are 365 days in a year. So he said that just divide the 365 with the debtors turnover ratio. So I said, okay, so you are having a debtors turnover ratio of 10. That means 36.5 days. On an average, you can assume that 37 days are taken by this organization to convert its debtors into cash. Fine. This is what is being said over here. So the ratio is calculated by dividing the days or months in a year by trade receivables turnover ratio. So if I want to know the answer in days, I divide it with 365, right? But if I want to know the answer in months, I will divide with 12. So I hope you are getting my point. Number of days or months divided by the trade receivables turnover ratio. Next is trade payables turnover ratio. So trade payables turnover ratio indicates the pattern of payment of trade receivables. Here, instead of in debtors, we were using the credit sales. Here we will be using the credit purchases. Fine. So net credit purchases divided by the average trade payables. How we are going to calculate the average trade payables? We know about it. Opening creditors plus opening bills payable plus closing creditors plus closing bills payable divided by 2. So this is how we calculate the average trade payables. Now you see, trade payables, they arise on credit purchases because we are purchasing something on the credit. That is why these trade payables are arising, and when we will be calculating the ratio, we will be using the credit purchases. Fine. Now the average collection period is average payment period. So in case of your trade payables, you have average payment period. So the same kind of thing is there. Number of days or months in a year divided by the trade payables turnover ratio. Whatever trade payables turnover ratio you have found out, you have to divide with that. Now it reveals average payment period. Lower ratio means credit allowed by the supplier is long, or it may reflect the delayed payment, which is not a very good policy, as it may affect the reputation of business. See, what happens is that trade payables ratio, neither too high is appreciated, neither too low is appreciated, right? So if it is low because your supplier is giving you a higher credit period, that is good. But if it is low because you are making delayed payment, supplier has given you just the time of 20 days and you are taking your own sweet time of 30 to 35 days in order to pay the payment, that is not a good thing, right? So there are various scenarios that are there in the consideration of the trade payables ratio. Now next is we have net assets or capital employed turnover ratio. So normally the question comes in form of capital employed turnover ratio. They ask it like it. Capital employed turnover ratio. So I'll tell you, in most of the cases wherever turnover comes, apart from trade receivables as well as trade payables, fine, turnover means in the numerator you have to keep the revenue from operations. That means in the numerator you have to take sales. Fine. So if someone says that what is capital employed turnover ratio, I will say that because turnover is written, so hence I will keep in numerator sales and in denominator I will keep capital employed. What was the formula of capital employed? Yesterday we did the formula of capital employed as well. Can someone tell me that what was the formula of capital employed? Please watch yesterday's lecture if you didn't. Capital employed means that what is your own funds plus your liabilities that you have taken, long-term liabilities. Long-term liabilities plus shareholders' funds, they both together form the capital employed. So it reflects the relationship between the revenue, what is the amount of revenue you are earning from your business, and what are the net assets you have employed in the business. Higher turnover means the better activity and better profitability, right? Now see, your capital employed turnover ratio, it can be further subdivided into two kinds of ratio. I'll tell you the whole scenario over here. Once. Just this is for the sake of understanding. Okay? So this is your balance sheet. Now, in one side of balance sheet, you have fixed assets. Here you have current assets. Okay. Apart from it, here you have your share capital. Let's name it shareholders fund. Shareholders fund, right? After that, you might be having long-term liabilities, or let's say long-term debts, and then you will be having current liabilities. These are the broad bifurcations, right? Now, whenever I am saying capital employed, I am saying this. If I will have to say just shareholders fund, if I'll have to say just shareholders fund, so I will just use this, correct? I will just use this, but I have to say the capital employed, so I will include both of them. Just wait for a second. Yes, so this is my capital employed. My own funds as well as the long-term funds that I have borrowed. Now, if someone says that what is the other way you can calculate the capital employed? So what I will say that yes, one way is shareholders fund plus long-term debts. But apart from that, capital employed is equals to fixed assets plus current asset less current liabilities. Am I right? I can also say that because in balance sheet both the sides are equal. So this plus this minus this will be equivalent to this. Fine. Now in this particular case, can I also write it fixed assets plus working capital? See, why I am writing this, you might be thinking that why it is important, but sometimes the MCQs, they can be formed in a twisted way, right? They can ask you that capital employed is fixed asset plus working capital. So you should not get confused. You should know that this is also a correct interpretation. That is why I have made this balance sheet. This is why I have explained this. So we know that capital employed is obviously shareholders fund plus long term debts, but apart from it, it is also fixed assets plus working capital. Working capital is what? Current asset minus current liability. So I can divide the capital employed turnover ratio in two parts. That means one part is fixed assets wala part and the next part is working capital part. See, capital employed turnover ratio, which studies the turnover of capital employed, is analyzed further by following the two turnover ratio. What is it? Number one is the fixed assets turnover ratio, that is net revenue from operations divided by net fixed assets, and next is working capital turnover ratio, net revenue from operations divided by the working capital. Fine. Net revenue from operations, this is your sales, net sales. What is meaning of net sales? So sales minus returns. Whatever returns, the sales return that you have already done, please deduct it. Okay. So high turnover of the capital employed, working capital and fixed assets, it is a good sign. So please keep a tab on to these that, okay, yes, a high capital employed turnover ratio is always a win-win situation. Why? Because it says that you are utilizing your resources great. So for example, suppose over here, if I am having 100 rupees capital and if I am able to make 700 rupees worth of revenue out of it, that means 7. It is the high capital employed turnover ratio. It means I am using my capital in a much efficient way, that shows because I am able to earn a higher amount of sales. Okay? So this is how it is represented, that a high capital employed turnover ratio is always good. It represents your efficiency. Now next, we will be moving on to the profitability ratios. So profitability ratios, they calculate the earning capacity of the business, which is the outcome of utilization of resources employed in the business. Number one out of it is we have the gross profit ratio. Gross profit ratio, see, in profitability ratio, 100 is multiplied with each ratio. Why? Because we calculate the profitability ratios in percentages. ठीक है, we calculate the profitability ratio in percentages, and gross profit means what? How gross profit is calculated? So sales less cost of goods sold. This is how your gross profit is calculated, right? And how cost of goods sold is calculated? So cost of goods sold is opening stock plus purchases plus direct expenses like labor related or carriage related, and less closing stock. Opening plus purchases, plus direct expenses less closing stock. This is how cost of goods sold is calculated, right? So this is how the calculation is done. Now gross profit indicates that how much profitable your business is when only direct expenses are deducted. ठीक है? Now net profit में तो हम indirect expenses भी deduct करेंगे, but in the gross profit we only deduct the direct expenses. See over here, it indicates the gross margin on the products sold. It also indicates the margin available to cover operating expenses, non-operating expenses, etc. So changes in gross profit ratio may be due to the change in selling price or cost of revenue from operations or combination of both. Now you can tell me very easily that yes, whenever we are talking about the profitability ratio, what we want is a higher amount of profit, right? Even in gross profit ratio, even in net profit ratio, like that. We want a higher amount of profit. So high gross profit ratio will be suitable because that shows that your business is able to cover the future expenses that might happen. Okay. Now next is operating ratio. Operating ratio is a kind of expenses related ratio, but this is included in profitability ratio. Why? Because we will see there is a operating profit ratio as well. So there are two ratio. Number one is operating ratio, and after that we will see a operating profit ratio. What did I say? Operating ratio and operating profit ratio. So operating ratio, it tells you that what are the costs of operations. Cost of operations in percentages to the sales that you are doing. So operating ratio, cost of revenue from operations plus the operating expenses divided by net revenue from operations, that means your sales. Now what are the expenses that you are going to include in operating expenses? So your office, administrative, selling, distribution expenses, depreciation, employee benefit expenses, they are all operating expenses. See, listen to me very carefully. So in one of the topic also I have explained you. See, we'll just clarify this. So there are three kinds of activities. Operating activities. Operating activities means if I am doing the business of manufacturing of medicine, right? So whatever expense, income I am earning because of medicine business, that will come over here, operating. Next is investing. Investing means what? Investing means suppose I am into the business of medicine manufacturer, obviously, and I have invested in shares of Tata, or suppose I have purchased a residential apartment. That is investing. That has nothing to do with my business of manufacture of medicine, right? So that is called as investing activity. And third, we have financing activity. Financing activity means suppose any expenses that has been incurred on the issue of shares, on the issue of debentures, paying dividend, like that. They are all what called as the financing activity. Now I'll tell you what. See, labor related expenses. This is also an operating expense. Carriage related expense. This is also an operating expense, right? Your selling expenses, that is also an operating expense. Your office expenses, that is also an operating expense. Why? Because all such expenses are important in order to carry out the business of medicine manufacturer, right? But here is the thing, the above two, they are categorized as direct expenses. So they will be called as direct operating expenses. They are shown in the trading account. The below two, they are the indirect expenses. They are indirect expenses. So called as operating indirect expenses. They are shown in the P&L. इनको कहाँ दिखाया जाता है? प्रॉफिट एंड लॉस अकाउंट में. इनको कहाँ दिखाया जाता है? ट्रेडिंग अकाउंट में. बट एट द एंड ऑफ द डे all four are called as operating expenses. So I hope that you will not have any kind of confusion between the treatment. Fine. You know that these are direct expenses, these are indirect expenses, but together they are called as operating expenses. Investing में most of the cases it involves purchase of land, right? That has got nothing to do with your business. Purchase of building, purchase of machinery. Obviously machinery is for my operating business, but the total cost I cannot charge to my expenses, right? So that is why it is taken as an investing thing. Apart from that, suppose I have invested in some shares and from that I have received dividend. So that is also investing activity. Financing activity like issue of shares, issue of debentures, fine. Dividend paid. Chalo, I have a question from you guys. If you have studied the cash flow, can you just tell me that tax paid is which kind of activity? Operating, investing, financing, what kind of activity tax paid is? ठीक है? You have to tell me this. Operating, investing or financing. I am asking tax paid. Where I should classify this? Operating activity, investing activity or financing activity? Please tell me, okay? See over here. So I told you that what our operating expenses are. So now you must be clear that, wait for a second. Office expenses, administrative expenses, your distribution, employee benefit expenses, they are all operating expenses. Fine. Cost of operation includes what? It is determined by excluding the non-operating incomes and expenses like loss on sale of assets. This is a investing kind of thing. Fine. Interest paid. This is a financing thing. Dividend received, again a investing thing. Loss by fire, this is obviously a operating related thing but an exceptional thing, right? After that, speculation gain. So such kind of things which are not directly related to your business. See, if you are purchasing, selling any particular assets and you have incurred loss onto it, this is not operating activity. You have not incurred loss because you have doing the business of manufacturing, medicine manufacturing, right? You have not incurred that loss for, so hence it is called as the investing activity. So all such things should be excluded. That means non-operating incomes and non-operating expenses should be excluded, and then you will get the cost of revenue. Yes, very good, Nivedita. Taxes paid is an operating activity. Okay, taxes paid is an operating activity. Next is operating profit ratio. So once we have calculated the operating ratio means the expenses. So 100 minus operating ratio will be your operating profit ratio. So you should know the alternatives as well. See, operating profit ratio is operating profit divided by the revenue from operations. Correct? So it helps to analyze the performance of business and throws light on the operational efficiency of business. It is very useful for the inter-firm as well as the intra-firm comparison. Now, how operating profit will be calculated? So out of your total profits, if suppose you have given net profit, suppose I have been provided with net profit. So what I will add back? I will add back non-operating expenses that have already been deducted while calculating net profit, and I will deduct the non-operating incomes that would have already been added in the net profit. So अब मैं उनको deduct कर दूंगी. This is going to give me my operating profit. And apart from that, sales less cost of goods sold less just operating expenses, add just operating incomes will give you your operating profit. But we do not have to go into that much depth. Fine. Next is your net profit ratio. So it is all inclusive concept of profit. Everything is included over here. Whether they are operating profits or operating incomes, non-operating profit or non-operating incomes, everything is included, right? Nothing is excluded in the net profit ratio. So see over here. Net profit ratio is besides revealing the profitability, it is the main variable in the computation of return of investment. It reflects the overall efficiency of the business. So net profit divided by the revenue from operations. This is called as your net profit ratio. We are still left with the three ratios, right? 3-4 more ratios. We will cover it with the tomorrow. We will cover it tomorrow with our any particular session that will be happening, or let's just cover it. We have still 4-5 minutes, so we'll cover it. Return on capital employed or investment. Return on capital or employed or investment means profit before interest and taxes divided by capital employed. I have already told you how the capital employed is calculated, right? So return on capital employed, it means EBIT, earning before interest and taxes, divided by the capital employed. It tells you that whatever capital you have employed from your own funds or from borrowed funds, they totally how much income they have able to generate, right? So it measures the return on capital employed. It reviews the efficiency of business, right? After that, we have return on shareholders fund. So capital employed is the sum of shareholders fund plus long term debts, right? This is a comprehensive measure. But now I want to see that what is the profit that is available for my shareholders. So you see over here, suppose this is the profit I have earned. Out of this profit, firstly I will deduct the interest. Why? Because the long term debts I have taken, onto which I have to pay the interest. So I will deduct that. After that, my tax will be calculated and tax will also be deducted. By after this, I will receive the profit after tax. Okay? This is the profit which is available to shareholders, because shareholders are the owners. So they first have to pay the payment to the outside persons from whom they have taken loans. After that, they have to pay tax to the government, and finally whatever is left, profit after tax, they can have. So return on shareholders fund is equivalent to profit after tax divided by shareholders fund. This ratio is very important from shareholders point of view in assessing whether their investment in the firm generates a reasonable return or not. It is higher than, it should be higher than the return on investment. Very important. See, return on investment that we have calculated, return on capital employed, right? Now shareholders should get a higher thing. Why? Because otherwise, what is the profit of being the owner? So this is your return on shareholders fund. After that, we also have to know about the EPS, MPS. Apart from that, some leverage related ratios that are also important, miscellaneous kind of things, and can be asked. So we'll be covering them into our tomorrow's session. This is it for this particular session. Thank you so much for joining in, and I hope you did like this particular lecture.